Okay, very good morning all. Thursday the 1st of February, so I hope everyone is well. Give you an overview of what we're going to cover. Next kind of 25 minutes or so, we'll look at the Fed statement from last night. Janet Yellen's obviously last meeting. We'll see what happened, how the markets react, and we'll look at the statement specifically and the word changing to see how the land lies now for what is priced in for a March interest rate hike. We'll then have a look at a few other things. There's been a couple of corporate earnings to touch upon, and then we'll kind of review January's performance from an equity perspective, because it's worth looking at a couple of stats this morning to put it in some context. And then, as per usual, I'll hand you over to Sam, and he'll have a look at the charts from a trade setup and technical point of view. So, let's start with the Fed before we get into the Jan review and where we are at the moment. And first of all, we're seeing a little bit of dollar weakness as Europe has come into the market. Now, the dollar looked like it appreciated overnight in the Asia-Pac session. Possibly a little bit of digestion of the Fed statement. But ultimately, I guess, as we're going to see shortly, it's continuity, which really is the key word that's come from the communication from the Federal Reserve. And if anything, this kind of remain of gradual approach means that the dollar, quite rightly I think this morning, Europe's come in and interpreted it a little bit different to Asia, and we're seeing a bit of a pullback in the Dixie. Consequently then, top left, both major currency pairs are seeing a bit of a lift. In terms of short-term technicals, euro-dollar already moving above that Asia-Pac resistance, which was the daily pivot. And we're above there now, trading at 24.66. But cable has seen quite a pronounced move on the back of that dollar weakness. Remember, this isn't a pound story. There is no real fresh fundamentals for the pound. This is more dollar movement, so it's a continuation very much of the same dynamic that's been driving the markets the last week or two. And you can see here that R1 level, which was just around close proximity to the high printed in cable yesterday afternoon, that already being broken has led to a bit of an extension of that move. If we start looking at potential targets on the upside, you got the 43 handle, which comes just before then 43.12, which was the 26th high, and then R2 sitting just about 4 pips or so above there. So, you know, if you're in that long, some levels to be on your radar as we continue to move to the upside in the currency pair. Quick look though at the other markets. The S&P, broadly speaking, is pretty much unchanged from where we were prior to the release of the Fed statement. So really, this is where we were trading. This is where we're trading now. So net, despite the brief dip and then recovery into the close on Wall Street, we are exactly where we were, and it's a pretty similar story for the US 10-year. The one that does look a little different in the fixed income space is the Bund. Yields remain on the front foot for the time being, and if you start looking at the Bund on a bit of a longer time frame, really this is a continuation of a pretty definitive trend which has commenced since we came in for 2018. So the month of January as a whole, the Bund has been under a large amount of pressure, and this is because overall what we're seeing is that the European Central Bank is getting ever so cautiously more hawkish, is probably the best way to coin it, but economic conditions are generally picking up, which warrants that slight subtle change in communication, and then we're starting to see movement here to the downside continue for the time being. So let's have a look at the Fed statement and what exactly happened, just for the benefit of some of the newer guys, and what this looks like. So I've found this quite neat side-by-side comparison, where what they've essentially done is they've got the December, the release that we saw in mid-December and the one we had last night, and they've basically scratched out but kept the wording there, so you can see the actual words and how they've changed in their description of each of the specific key areas. So this is what experienced traders are doing when they hear these comments come out. How this worked last night from a kind of release format, if you like, is that the news wires have already had access to this statement about half an hour before via embargoed. They release it then at 7 p.m. London time, and then what you see is, or what you hear is comment from the squawk. Now, how do you break down that noise into something a little bit more actionable? Well, this is when you start to need to understand monetary policy and what is it that the Fed are monitoring with most intent, if you like, to then make policy decisions thereafter. And so what traders will do is look to the same area because they know that's where the market move will happen. And ultimately, what has been the case for the last few months with the Fed in particular, it's inflation. So rather than looking at other things around maybe growth and areas like that, what we're specifically, zoned in on is the inflationary comments. And so that's exactly how the market took it yesterday. So a couple of comments here that have changed, and here on a 12-month basis, both overall inflation and inflation for items other than food and energy. So the previous statement said have declined this year and are running below 2%. So they've scratched that comment and they've said items other than food and energy continue to run below 2%. So it's a slightly alteration to that comment. Obviously what we've had here is a strip out of that entire, if you remember the hurricanes, the multiple hurricanes at the time that hit the Texan coast, the Florida region. So this has been dropped, which is absolutely no surprise. And then if we continue to go further down, this is really one of the key phrases here, and it looks small, but when you know your kind of central banking 101, this is the type of thing you're looking for, and it's this sentence here. The committee expects that economic conditions will evolve in a manner that will warrant, and they used to say, gradual increases. They've said now, further gradual increases. I know it doesn't sound like a lot, but that addition of just one word being further in a market which was kind of prepped for a fairly, I wouldn't say outright hawkish, but there's plenty of reasons to be optimistic about the economic performance in the US to warrant their plan of further interest rate rises to come. But the fact that she said, the FOMC said, that they're going to have further gradual rises means that despite inflation picking up, they're going to go very slow and steady and gradual. And what you actually had in the market was an initial reaction to the inflation comment, which was dollar strength. That lasted for a matter of seconds. The prevailing move thereafter then was the interpretation that actually this is continuity, the line's been kept by Yellen, her kind of classic cautious stance has been maintained, and this is kind of, I think, why you're seeing a bit of dollar weakness this morning. As much as the Fed are on track, definitely for interest rate rises, and the next of that's going to come in March as far as markets pricing is concerned. The thing is that they continue to keep that real key phrase, that they're going to approach this in a very soft manner in that respect. Inflation really is the key though for 2018 going forward. If that starts to really pick up pace, then they're going to have to alter that language. And now obviously Yellen is gone, as too is Stanley Fischer, William Dudley. The doves have been removed. Remember, the composition for 2018 is slightly more hawkish. Talking of market pricing, so why am I so sure the Fed are going to raise interest rates in March? Well, this isn't an opinion, this is market pricing. And as far as short-term interest rates are concerned, there is now a 93% probability of a 25 basis point rate hike from the Federal Reserve in March. And then for, again, the newer trainees, why March? Well, typically the Fed like to move in March, June, Sep, Dec, if they're being isolated as the 4 events out of the 8 in a year, because of course they're the ones when you have the summary of economic projections, so latest updates on things like unemployment levels, GDP, PCE or inflation, and then also their dot plot matrix, so their outlook for interest rates going forward. And then you'll have the press conference now with Jerome Powell. Now I can't wait for Powell because if you remember Janet Yellen's first press conference, even though she's highly experienced even before taking over from Bernanke, she did buckle a little bit under the pressure and made some mistakes in the Q&A portion of her very first press conference. So like every intraday trader, I'm hoping we'll get the same with Jerome Powell, and he makes a bit of a hash of the event, which will provide us with some additional market volatility. All right, a few other things. Again, Sam will look at the charts more thoroughly in that respect. And this is having a look at January, because January has been a really interesting month, because what really defined the second half of 2017 was record all-time low levels of volatility as measured by things like the VIX, for example. What we've got here is, I saw an interesting infographic this morning from Goldman's, and they're saying that January has been the most volatile month in terms of realized volatility in percentage terms since November of 2016. And of course, you'll all know and remember what happened in November 2016. That was when Mr. Donald J. Trump came in, surprised the market, defeated Hillary Clinton, and we had that big volatility at that point. The initial negative reaction on the night before then, we rallied higher. So quite interesting to see that volatility, which had been essentially, close to nothing for such an extended period, is starting to pick up, and this certainly is welcomed by the prop trading community, because it does make conditions a little bit more fruitful, if you want to call it that. This is another interesting graphic as well, just to summarize January's performance, because January was extremely strong as far as the S&P 500 is concerned. And what I've got here is a table which shows you S&P 500 performance in recent history and January returns that have been in excess of 5%, as was last month at 5.6%. So we actually rallied up about 7.4% in the S&P. We've obviously come off a little bit at the beginning of this week, combination of lots of different things, but net we finished the month up 5.6% or so. What you can see here is that for every one of these last previous occasions where January has started with a more than a 5% gain, by the end of the full year, every single year is up, and by fairly substantial margins. As you can see, the average is 25%. So, remember, hold him to his word. Sam North made the call yesterday, and he's it looks like it's playing out at the moment, but 25% has been the average return if you go back to 1951. Now obviously these are stats, they do need to be taken in context of the economic, political and monetary environment, but I thought I'd just point that out. A couple of other things that we've had this morning. Obviously we're in the midst of earnings season. You've had Shell report, one of the bigger FTSE names, of course. So just looking over the headlines briefly, Royal Dutch Shell profit more than doubled in the fourth quarter, $4.3 billion, which was slightly ahead of forecast. I don't think really this comes as a huge surprise because of the price of oil, essentially. We've seen, if you remember, it was only a few months ago, we were trading we were down at a 42 handle, and now here we are knocking on the door of 65 this morning. So profits going up, just to point out, given their large market weighting. I did want to just quickly have a look at a single stock though, and to point out, I guess from a learning perspective, that when it comes to reacting to single stock information, it's not always as binary as earnings per share, net profit beat, and therefore you can expect movement in that stock higher, or the index, if it's a large weighted company, to move higher. What we did have yesterday was the Dow future moved sharply higher pre-market open. Now if you remember, that was because Boeing reported really excellent earnings, and they account for 9% of the Dow. So make sure that on your economic calendars, I know you've got them all printed out and to hand, circle which companies are coming out. Now don't forget that tech companies, broadly speaking, will come after market. So for you guys, that's not what you're going to be so concerned about. It's the pre-market names that you need to be aware of. So every day, whilst in earnings season, you need to be checking this. One of the companies I just wanted to have a quick word on was Facebook, because check out Facebook shares after market yesterday. That is, if you were trading or looking at those shares, that's a pretty nasty chart, because we fell 5% in their shares, very volatile in that intermittent period, but within an hour we then recouped the 5%, rallied 4%, and then came back down to up 0.1%. And so it really goes to show the market's kind of the way it reacts to the information that it has at hand, i.e. us as human beings, how we interpret information. By that, what I mean is when Bloomberg report Facebook earnings, the headlines are earnings per share and then the revenue number, for instance, and the market reacts to that first. Then the market starts to read the deeper layer of the earnings report, and then what you saw with Facebook was that they said users had spent millions of hours less on the platform in the final months of last year, and North American daily active users had declined for the first time. To give you a bit of context, time on Facebook declined by roughly 50 million hours every day in the last quarter, which is about 5%. The number of users in US and Canada logging on every day fell 700,000 people. So again, what's really important here is that sales at Facebook, so monetizing their feed for advertisers, for instance, they actually beat expectations. So this is when, if you're going to trade stocks, and not so much Facebook as aftermarket, but if you're going to do this in future outside of index futures and so on, you really got to know these companies inside out. And what is it specifically the investment community is focusing on? Because someone like Facebook, very similar to Netflix that we saw recently, it's about subscriber numbers, active users, new additions to members to the site. These are things of which are going to be the thing that will produce future revenue and income for that company, and what investors will trade on sentiment. So hopefully it's just making a little bit of sense of some of these corporate earnings that we've had. Okay, a few other headlines. We've had China's manufacturing PMI overnight, and it was essentially unchanged from previous. There was nothing really too surprising there, so I'm not going to dwell on that too much. Going to look ahead on the calendar. We have already had the commencement of the European PMIs this morning for manufacturing, so let me give you a quick run through. We just had the Italian manufacturing PMI, so Ilya, I can quite happily say manufacturing is up, stronger than expected. 59 against expected 57.5. While Sam is on in a second, just to make you aware, you've got the German PMI that's coming out at 855. If you're in any euro currency position, you've got to be aware of that number. It's coming out in about 5 minutes time. You've then got the Eurozone number, which will be basically the assumption of everything put together in that sense. UK manufacturing PMI comes out at 930. Now, that definitely does need monitoring, but of course, being a service-based economy, that's going to be the number we'll be looking out for with kind of more interest. But nonetheless, manufacturing here, you can see, has dropped off going into the tail end of when it peaked in November. It dropped back to revert to the mean, if you like, in the month of December. What are the expectations for the UK reading? For pretty much the same. Your bottom end of the range, 55.5. And that would put us probably down here, which puts us down, if that was to come out, well, that's the ISM, and we go back to the UK. So here, I don't think that's really going to spook the market too much. And as I say, from a cable point of view, it's more really the dollar and technicals associated with that pair. They're going to be more influential, I think, short term. Going further forward, you get the market manufacturing PMI for the States, but the more important one will be the Institute of Supply Management, the ISM manufacturing, 3 o'clock. What does that look like? Well, here it is. We printed last time at 59.7, which was above expectations and the highest number in 3 months the last time this came out. So again, just given the close proximity of the Fed statement, and given the fact that even on the most broadest ranges, this data is really not going to fit too much towards something that's going to change market perception of Fed and what they're going to do in the future, it's going to be important, worth monitoring. Whether it will shape the rest of the session, I probably doubt it. The employment constituent will need to be watched, though, for the payrolls release, which, of course, is coming tomorrow. Earnings-wise, just to keep you informed then, you've got Apple Alphabet, and Amazon. So these are like the three amigos, if you like, of the tech space. These are the big boys, but they're not going to come until after the closing bell. So we're going to be recapping that tomorrow morning. But if you are watching markets later tonight, definitely be aware of those. Other ones of significance: Alibaba, Visa, DuPont, Amgen, ConocoPhillips. They're all pretty big companies, so worthwhile just monitoring what the general trend is of those earnings reports. Okay, going to quickly hand you over to Sam. The French manufacturing PMI has come out as well whilst I've just been speaking. Slightly higher than expected. Again, the German number is out in about 2.5 minutes. Okay, guys, have a good day. I want to bring that up as well.
Yeah. Hi guys, yep, so I'll try to do it as quick as possible. I know obviously a few of you will be focusing on that euro number that is about to come out in just under 2 minutes now. So we'll have a quick look at the euro. We have had a bit of dollar weakness this morning, just printing new lows for the dollar index actually as of a few minutes ago. Important resistance level to the upside here, where we found resistance obviously last night from the Fed. And then really it would be then a push onto the R1 level and yesterday's high. Pivot has found good support. I know a couple of people took that classic on early on this morning and has worked quite nicely. I would be looking to, well, really, make it completely risk-free by now, which I know the guys have. So well done, good trade. Definitely looking to take some around this level if you can before that release comes out. Elsewhere, dollar related, let's have a look at the pound. The classic from yesterday's high was a great trade. Let me lower the time frame down just to show that in more detail, so you can see a lot of the time when you do have two levels, in this case yesterday's high and R1 close together, you get that breakthrough, but it's the market level that has a bit more reaction. So we come back to test that pretty well, and then obviously you can then use the new high of the day as the first target before pushing on. And you can see now not too far away from the high of the day. Good target area 78, and as Ant mentioned briefly earlier before, 143, and around this sort of pullback that we saw the back end of last week as well. Looks nice before we could even push on and then start looking at the high of the 26th. So I'm just going to pause a second for this data. Obviously it will be a bit delayed for when you hear it, so I'm sure your squawk is all on. I'm just going to turn the squawk up. 61.1.
61.1, that's 61.1. Below expectations, 61.2.
Okay, so very, very minimal miss on expectations there, and not going to do too much. Moving over to other markets, have a quick look at Aussie dollar, which obviously come under some pressure early morning and rebounding understandably with the dollar weakness that we've had, and also a very strong support level to keep an eye on that 26th or the 25th of Jan level. If we can push below there, then the door will open up a bit more to some levels further down, not seen since middle of January. So obviously today, first trading day of the month. It'll be interesting to see obviously how this week finishes, I think, for a lot of these markets. And if we just have a quick look back at the euro, for example, it has been really quite confused in the direction where it wants to go. Same with the pound until maybe just now pushing above. But it has been a tricky week so far in terms of looking to get a clear direction. So in terms of where this week finishes, I think will be quite important, and also for US equities as well. If I just put this onto a weekly chart, just bear with me 1 second. There you go. So you can see that's the first sort of down week that we had since sort of that one in middle to late December, but obviously quite a significant down one as well. I think all the the technical tools out there. Obviously, RSI has never been as high as it was in those 90s. Is screaming that we do have a bit of a pullback, but in terms of intraday, where we could go, a couple of days obviously remaining of the week, and I'm pretty sure that let me just remove the RSI here. that the bulls haven't given up just yet. Starting to perhaps get a bit of a trend line forming from previous highs that you would want to have on there, using the high of the afternoon of the 30th and 31st, and just today's as well. So something to have on. R1 looks like a good level of resistance as well. Elia's just celebrating his DAX trade, which will make me want to go on to that, and you can see here coming down to near that low point of the day. It's still going. I know I shouldn't be laughing, but he's obviously very happy with that, and it was a good trade to go through, and it really did pick up momentum once breaking through that R1. Yeah, nearly almost down to the pivot, and picking up a bit there. So something to keep an eye on here, as it could drag down other equity markets. The Nasdaq just coming under a bit of pressure to that R1, which is obviously, as you see here, the support area from early this morning. So I was going to keep an eye on this DAX to see if there is anything left in it. But expect some support around the pivot for sure. Look elsewhere. Have a look at Euro stocks just to see similar sort of move, nowhere near as big. So, you know, obviously the DAX a lot more liquid and choppy, and you can see just from today's price action with that DAX that up down. It's very tricky to trade at the moment. I would just be very careful for anyone looking to get into the DAX now. It would take me something very big to get in. Hands away, I would leave it now. Have a look at gold, just coming down, and the what was the low of the day is acting as pretty good resistance here. A good area to keep an eye on. Obviously pivot, and then previous lows are another resistance point to bear in mind. Push lower here, and then obviously the low of the day could be a nice target before S1, and then it opens the door, I should say, to the FOMC low that we saw at the back end of yesterday's trading session. Quick look over oil. Classic data release yesterday where it was near impossible to trade. Went down, went up. The only real opportunity in hindsight was going long at what was a very strong support level of those lows of the day. It's always a tricky release. I think you need an element of luck, because it can go wrong very quickly when trading that. But yeah, pushing on this morning. Keep an eye on that high we just made around $65. The morning high, or Asian session high, at around 5 o'clock, 64.90, could offer some good support here for that push higher. Oil, again, another market that has been quite undecided this week in terms of direction. I think that's really been the theme, definitely in FX, but for oil as well. Equities obviously continuing to make lows each day so far, so it's something I would bear in mind today. I don't think you can necessarily have a longer term bias as of yet. I think it's very much a case of let the market tell you what's going on. Just to wrap up, I think it's definitely worth, for those interested in the crypto currencies, to have a quick look over at Bitcoin here, which is, well, it has been obviously trending down since that futures open in the back end of December. We are, as we speak right now, below 10,000. The key area, I would say, that is holding the door to that move lower, as you can see, just circled here. So we did make a decent low yesterday, 9,500, the main one, the 17th, which we got. Let me just hover over that, nearly below 9,000. That is going to be an important area. I feel if this goes, then it could go quite quickly. We're making new lows over the last few weeks in terms of the highs, so prices perhaps getting squeezed in. Definitely worth keeping an eye on there today. Obviously a new month, would have been the worst month for Bitcoin in quite some time, so we'll keep an eye on that. Can we push through? Big areas of support made last month, and I feel that will really open the door to the downside if we can break on through there. Obviously 10,000 has been a sort of a magnet for price. Anytime it looks to get away, comes back towards it at the moment, so one to keep an eye on. Have a quick look over the DAX, as that's been the main mover this morning before we wrap up, and you can see already started to pair some of that brief technical break to the downside, so be careful on the DAX. now if we just have a look exactly where we're trading, I mean, it's a bit of a mess. So have a good day, and I'll catch you in the chat as well. And also, any questions, please do let me know.